Thank you. Thank you, Lan, for the introduction. So my name is Greg. I'm here with my colleague, Raad. All good?
Yeah.
Thank you for the introduction. Thank you for the chance to present to you today about our submission to the practice prize. What I'd like to do is talk to you today about the how and the why NatWest Group have transformed from an organization that has historically been very product-focused to one that has the customer at the heart of our strategy. And we'll discuss how we've embedded that throughout the whole enterprise. To set the context, NatWest Group is a large UK banking organization. The mission of the bank is to help people, families, and businesses to thrive through every stage of their life. We have over 19 million customers that stretch from individuals in a retail bank through to family offices in a private proposition, and from sole traders to startups to large corporate institutions in a commercial bank. Many of those parts of the bank have histories dating back 200 or even 300 years in some cases, and they've seen radical change over that time. And in some sense, what we're discussing today is the next chapter of that change, as we transform the organization to one where customer centricity is embedded through everything that we do. Before we get into the detail, I'd like to pause for a second and hear from our Chief Data and Analytics Officer, Zach Anderson. Zach has been fundamental to the move towards this customer centricity when he joined the bank over 4 years ago. And he has a diverse experience which offers a unique perspective on some of the motivations for the work, the challenges that we've faced and overcome as we've done that, and then some of the impact that it's had across the enterprise. So let's hear from Zach.
Throughout my career, I've seen many implementations of CLV models. They usually are focused primarily in the marketing department. At Nissan and at EA, that's where CLV started and mostly resides today. At NatWest, we've implemented CLV across the entire bank, in every part of our franchise. We have had to analyze millions and millions of data points and build models for very different customers and for very different relationships, whether that's in our commercial banking division, in our wealth management division, or in our retail division. I think it's really innovative how this team has implemented CLV. It's not just a number, but it's a strategy that drives how we go to market every day and how we ultimately even evaluate what our customers and how our franchises are doing. The development of and integration of this methodology has brought together people from across the organization to innovate for our customers. The collective expertise of over 200 individuals, including data scientists, engineers, product teams, marketing professionals, and frontline staff, has been instrumental in this effort. CLV is now part of our day-to-day and week-to-week operational framework. It's at the heart of what we do. The impact of this on our wealth franchise has been significant, as evidenced by an uplift in our new net assets under management by between £1 billion in the first half of 2023 alone. In our commercial and institutional franchise, for example, we've seen a 23% increase in new net lending drawdowns, valued at approximately £40 million, thanks to our CLV-driven lead identification. One of the unique things about this implementation of CLV is that the insights from the models have also been used to create new products like Rooster Money, which is helping children develop positive money habits. This initiative is a prime example of how we're extending the value of our model beyond traditional banking, fostering financial literacy and securing future customer relationships. Thank you for considering our work, which we believe sets a new standard for the application of marketing science. It demonstrates methodological rigor, technical originality, and the ability to tackle complex problems. Our work is not only transportable to other contexts, but also carries the charm that engages stakeholders across the bank and contributes positively to the society that we operate in.
Great, thank you, Zach. So really the management problem that we're looking to solve here is how can we transform the organization from one that has historically been product-focused and focused on near-term value to one that is much more customer-focused and looking to build and engage customers for the long term. For some time now, we have had the ability to look at lifetime value of our product by product, as you can see on the left-hand side there for typical banking products that we offer. And we can also look at current value for different cohorts of customers as you can see on the right-hand side, for different parts of our organization, retail, affluent, and the wealth division, we see those different distributions of customer value depending upon that service level. However, what we've realized more recently by looking in our data is that every customer is an individual, and they each have their own journey, their own life arc with the organization. They may start off by taking a current account with us, but then move on to take a loan, credit card, mortgage, etc. And you can see an example of that typical journey for a cohort of customers here. And what we want to do is use that behavioral information to gain insight and to build then some models that we'll discuss later to really understand and to apply some marketing science in terms of how we contact customers, how we select customers for interventions, and how we engage them across that journey with us. A customer lifetime value framework, I'll just give a quick overview just now. As you've heard from Zach, really we're looking to establish a really new way of working in the organization, which is using data and analytics to drive and anticipate customer needs and use that to then influence our marketing strategy, putting the customer at the center. The hypothesis that we're looking to test is all about how do we move from product-centric to customer-centric such that we can better simulate customer journeys across their life, how we can provide customers with the right messaging, communication at the right time, and then how we can use that information to better guide our products and product strategy and development. Our methodology for doing this is broken into three main components that Raad will talk about in a minute. The first of these is a comprehensive data asset that we collect across a wide variety of data sources on our products and on our customers. And we put that together to then get insight onto those individuals, and that then influences the insights we give to senior management and the models that we will build. We then experiment with different hypotheses. We build models and use that to then drive the particular marketing strategies that we want to then use for contacting customers. And finally, we use that to influence the product strategy and the interventions that we engage upon, which really focus on three main pillars, which are how do we acquire, engage, and deepen those relationships with customers for the long term. The impact that that's had, as we'll see over the course of the next few minutes, has been substantial. The modeling that we do has led to a substantial increase in the accuracy with which we can predict those customer behaviors over the long term. We've seen revenue increases from our retail base by those customers that have been contacted via CLV-driven marketing campaigns. We've migrated thousands of customers to different service tiers where we expect higher CLV over the long term. And we've seen in our commercial division significantly higher loans being written to those businesses that are selected by these CLV campaigns. And with that, I'll hand over to Raad, who'll then talk you through some of the detail of that methodology.
Thank you, Greg. Before I get started and discuss our framework in more detail, I'd like to highlight our duty and commitment to our customers as a bank. Before we started any development, we made sure that we put a rigorous process in place to ensure that our framework is responsibly designed and implemented. To start with, we clearly define risk and business owners. We also went through privacy impact and ethical assessments to understand and mitigate any potential data protection or ethical issues. We also went through thorough analysis of our data to uncover any potential issues or biases. And we performed rigorous model testing to ensure our models were accurate and transparent. This was also independently verified by our independent model risk team. And we finally put together processes in place to ensure that our framework is used as designed with ongoing performance monitoring in place. So with that, I'll now discuss our core framework in more detail. To start with, we really need to understand our customers better. But what we soon found out was that although there are many rich data sources across the bank, they're mostly used in isolation. For example, the credit risk team might use one data source, and maybe the marketing or financial crime teams might use different ones. So there was no full 360-degree view of our customers. And that's where we started. We went through a massive data gathering and engineering effort to pull together data from over 30 different sources, including data on the customers, the products they hold, their riskiness, their transactions and spending, their investments, how they engage with us and interact with us, and many others. By creating this data asset for the first time, combining over 400 billion rows of data, We've unlocked new insights into customer behavior and needs. And this data set is now live. It's being continuously updated with new information and has also been transported to support many other projects across the bank today and serves the foundation for a lot of the analysis across the organization. Now, with this data asset, one example of the power of it is our ability to link online behavior on our websites with customer product ownership information. So for example, we looked at our mortgage-related pages, and what we found was that customers who visited our mortgage calculator page were almost 5 times more likely to take out a mortgage with us than a customer chosen at random. Similarly, those who looked at our agreement in principle page were almost 7 times more likely to take out a mortgage within 1 year. Now, before we had this data asset, we never had this level of insight. We assumed these sorts of relationships and hypotheses existed, but were unable to quantify and test them. Now, with that, and with this data asset and these insights, they form the foundation of our next core component of our framework, which is the CLV models themselves. These CLV models allow us to simulate customer journeys to better anticipate their needs and predict customer value up to 5 years ahead, though it can be extended to any arbitrary time horizon. The first component of our framework differentiates customers by value and splits and defines our customer segments. To do this, we use machine learning to train a decision tree model that maps customers into over 50 different value states based on their product holdings, their balances, and many other bits of information derived from our data asset. One core feature that we've introduced here is the concept of forced splits based on product holdings at the top of the tree. As you can see in this dummy illustration, we're forcing splits based on investment, mortgage, and credit card ownership right at the top. And what this allows us to do is it makes our segments easily interpretable, but also clearly defined based on product holdings, which has numerous benefits for our marketing and also relationship management. So with our segmentation, our next component allows us to estimate how likely a customer is to transition from one value state to another in the next period. To do this, we use machine learning, but to train a gradient boosting model with almost 1,000 features, encoding the customer's profile, their behavior, their transactions and spending, and as well as their current segment, to allow us to predict the probability of a customer transition to each possible state next period. This is really a core aspect of our model because what this allows us to do is estimate the probability of a customer moving to maybe taking out a loan to buy a car, maybe increasing their savings balances because they got a raise, or even churning and leaving the bank. Our third component here allows us to predict how valuable a customer would be in each possible segment in the next period. This is quite crucial for us as a bank because value is not deterministic, and there's a great deal of heterogeneity within our customer base. Not everybody who takes out a loan pays it on time or in full, and not everybody interacts with the bank's services in the same way, leading to quite different cost profiles. Therefore, 2 customers in the same value segment holding the same products might have slightly different values, and this is important for us to capture. So these 3 components put together allow us to estimate customers, allows us to understand customer segments a bit better, and also forecast their needs and behaviors 1 year in the future. But what we can do is repeat this process a number of times to really simulate customers' journeys up to, here we've used 5 years, but up to any arbitrary time horizon. And these models really have given us an unprecedented understanding of customer behaviors and needs. But building this a bank hasn't been easy at all. And there were numerous technical, non-technical challenges we had to overcome to make this work. For example, a single run of this framework is powered by over 9 billion computations and tens of thousands of lines of code. And this was no easy feat to engineer whatsoever. Especially at the beginning, we didn't really have the tech infrastructure tooling to make this work. And we had to go through a massive retooling as well as reskilling of our different development teams to engineer this. Now these models are live today across our retail, wealth, and business banks, and are continuously updated and retrained and monitored with new information. We also had to overcome some hurdles that we didn't anticipate. For example, we spent countless hours at the start of the project really trying to think through how best to define a customer. Because especially in a banking context, this becomes quite tricky because a customer might own joint accounts, they might be part of a trust, they might have own different products across our different franchises. So getting this right at the start was really quite crucial to making this a success. In addition, in order to get stakeholder buy-in, we really need to understand our model better and really explain its predictions. Historically, this has been quite challenging with black box machine learning methods, but we were able to use a technique called SHAP extensively to understand the drivers behind our model and really understand what's leading to an individual customer prediction. And with that, I'll pause to highlight a quote from Bruce Hardy, who is renowned for his work on CLV. So one of the things that impressed Bruce was our ability to take existing academic literature and really extend it to the practical challenges of applying at a large organization like ours, including our complex product mix, as well as the challenges of scaling it up. Now, turning to model performance, we benchmarked our model against a Markov model from the literature that uses historical averages and probabilities to estimate future transitions in value. And when we tested this model on a separate held-out test set, we found great uplift in performance. For example, we achieved between 19% and 40% more accuracy when predicting which segment a customer will transition to. We're also able to identify which customers will be in our top 2 value deciles with almost more than 20% more accuracy. And finally, we're also able to predict how valuable a customer will be with between 40% and 60% less error. But these models can also be used to predict individual customer behaviors. For example, we can estimate which customers are most likely to churn or leave the bank, which is historically quite a big problem and costs the bank over £100 million a year in losses. So looking at this chart here, you see that our top 10% of predictions of customers likely to leave the bank actually account for about 80% of our total current account and savings balance decreases. So this improved precision allows us to be more proactive with who we target and also really understand and be more specific about our engagement with them. As another example, our top 10% of predictions of customers likely to take out investment are more than 3 times more likely to do so than a customer chosen at random. Here, this precision not only allows us to improve our resource allocation, but also improves customer satisfaction by ensuring that our marketing and products are more closely aligned with their individual customer needs. So these models and this data has really given us another view of our customers and really helped us understand them a lot better. And going through this and talking to the different teams, we uncovered that there were a few popular misconceptions that we were able to understand a bit better through this analysis. For example, our marketing and sales teams used to think that customers aged 35 to 50 were by far our highest value segments. But in reality, what we found using our models was that it's a lot more nuanced than that, and tenure and many other factors play a large role in future customer value. Another common myth that we found was that recent graduates are less profitable than those who've been working for a few years. And with our models, we found that while this is true in the short term, within just 4 years, graduates are more than 60% more profitable than their counterparts. And finally, one of the biggest misconceptions we found was that value is largely driven by mortgages and our mortgage products. But in reality, what we found is that looking at our top decile of highest value customers, 40% of them don't have a mortgage at all, and their value is largely driven by investments as well as other types of products, which is quite interesting for us as a bank. And with that, I'll hand over to Greg, who will talk about how we use this data and insights to improve our marketing and strategy.
Thanks, Raad. So after that initial insight that we obtained from our data, from our modeling, we then launched some initial campaigns to start to test out to see how these things would work in reality. First of all, we started to engage and talk to our high-value graduates to understand their changing needs. These were all delivered via our mobile banking app, these messages. We then started to engage with our existing customer base to help them develop healthy habits with regards to their savings, to meet their savings goals. And we also then looked to anticipate potential home buying needs up to 12 months in advance and to proactively engage with those customers. In this last case, for example, those customers who were looking to buy, who we suspected were interested in a buy-to-let mortgage, we could see from the data, from the models, that they were living in their own home but receiving rental income, whereas those customers who were likely to remortgage were obviously living in their own home but spending more, transacting more on home renovations and home improvement products. Based upon those initial small steps, we then started to move into a scaling phase, building confidence with the business stakeholders all the time. In this case, we then started to we launched an initial pilot to a target audience of 18 to 35-year-olds. And here we saw early indications that the CLV framework was working. In this case, we could see from the targeted messages that we're launching out, we can see an uplift in current account balances, an uplift in savings balances when comparing the audience targeted with CLV-driven messages compared to a control group that was that didn't receive any messaging. And we also saw an uplift in digital engagement through that same group. Again, those small steps led to further stakeholder buy-in, engagement, and understanding of how this would work. And that then encouraged them to launch over 20 personalized journeys that have since led to over tens of millions of messages being sent via our mobile banking app. Those journeys are broadly put into four categories. One, to drive primacy, to get customers using our application, our services. Second was to encourage those healthy habits, to encourage saving within customers. Third was to engage with the youth market and grow that side of the business. And fourth was to, again, encourage that healthy behavior, encourage people to understand where they were by using our free credit checking tool within our mobile app. In combination, the customers that have been selected and targeted by those CLV-driven campaigns, we saw an uplift in income of over 6% compared to the control group that didn't receive any messages. So that, again, that impact to the bottom line further improved that confidence within the stakeholder community that this was a good approach to take. Following that initial pilot in the retail business, we then here we can look at a transportation of that CLV methodology into our commercial business. In this case, we wanted to understand the needs of our small to medium-sized enterprises and how we can support their lending needs. One of the challenges that we have within working in a large organization like NatWest is that there's a lot going on. And when we started the CLV concept within the organization, there were many other different marketing campaigns happening simultaneously to what we were trying to launch through this customer centricity component. One of the benefits, though, is that by having these direct conversations with our senior management, it really forced them to start to think about the introduction of universal control groups that were sufficiently large, representative, and robust, against which we could compare the impact of our measurements against. In this case, we can see the example of a campaign to support lending within the SME group of customers. Here we have a model as part of our CLV framework that can predict the need to take a loan up to 1 year in advance. And in this case, we've selected a cohort of customers that sit within the top decile of customers predicted to take that loan 1 year in advance. And we can compare the results against a control group and also a more traditional marketing campaign called Fund My Business, that middle column you can see here. So in 2022, we can see two things. So first was the customers that were selected by CLV have a higher loan drawdown rate by 3.6 times compared to the control group. And then the average loan size within that group per contacted customer was 2.8 times larger than the control group. That further gained that confidence with our senior stakeholders and then helped us move forward and to update the data set, train new models. The following year, we do that every month, but here we can see the results from the following year, where now we have more volume going to that CLV-driven campaign, showing that confidence, but also then we can see further increases in loan drawdown rate per group for the CLV group, and also an increase again of the average loan size as our modeling got more accurate by the inclusion of more data. I think that this really helped to break down a lot of barriers with the senior management within the commercial business. They were initially quite skeptical of the idea. From their point of view, they served business customers, and therefore the idea of personalization was alien to them. But through doing this work, we can show that by using that behavioral information, we really can start to personalize and tailor the messaging we give to businesses, and that does impact the bottom line. The final example I'll show is the initial transport of our CLV framework into our private bank, the wealth business. In this case, we were looking to write. I think one of the challenges with the wealth business is it's unique within NatWest Group. It's lower volume and it's higher value compared to our core retail offering, particularly when you go to high net worth individuals. That also means that our data asset that we have is different. It's more sparsely populated than in the retail case due to long tail effects and a more complex product mix that sits within the private business. And also meant that we had some challenges with regards to the modeling that we used. Raad spoke about how we did that. In the retail case, the unit of modeling was the customer, which typically maps to an individual. Whereas in the wealth case, we focus on a connection which maps to a family unit, a family office, or a trust. The first campaign that we launched was looking to identify customers who would be amenable to moving to a higher service tier. In this case, which we believe correlates to higher lifetime value. In this case, we sent out targeted emails. We created bespoke landing pages on our website that were able to have a conversation with the customer to extol the virtues of the higher service tier and to promote a discussion with them about potential products they could take at that stage of their life, such as investments. Within 24 hours of launch, the click-through rates we were seeing from those campaigns were significantly higher than the business would have seen from traditional marketing campaigns. And again, that really helped to break down those barriers and convince them that this was a useful way of working and thinking about how to contact their customers. And in fact, we actually had this actually led to the opposite problem where they were so keen. The private bank, by its very nature, values confidentiality, discretion, privacy for its customers. And the idea to sort of personalize those messages, so maybe to break down some of that confidentiality was something they were initially quite skeptical of, particularly when, in the case of NatWest, we bank many members of the UK royal family within that cohort. But again, the success of this work, this campaign, really helped to break down those barriers, break down that skepticism, and we actually then had the opposite problem as we tried to scale this within the private bank because they didn't want to even have any universal control group in place because they didn't want anyone to miss out on the potential opportunity that they were seeing through these initial results. We also realized quite early on when rolling out this approach to our businesses, we had to engage really early with the relationship manager community in our private and commercial business. They're the people that have those day-to-day conversations on the phone, over Zoom with customers. And we wanted to make sure they understood why customers were being selected for campaigns and what the drivers were that they should be using for the conversation. We had some feedback from those relationship managers that you can see here. It was all very positive. For example, this is the best data that we've ever received. And an anecdote we had at this time was there was a senior relationship manager who ran a team of people that were contacting customers day to day. And he was genuinely worried that the quality of the leads that we were giving him, they were almost too good. He was worried that the service model they had set up for the typical marketing campaigns wasn't good enough to deal with the quality of leads that they were having. And they were worried that they would burn through those leads too quickly and miss out on opportunity. And I think that kind of raises some of the challenges that you have when you have these powerful data-driven methods and you try and roll them out to organizations who are not expecting that power. I'll pause here just to maybe have a quote from Mark Jobling, our Chief Marketing Officer, who really recognizes that these data-driven methods are now a cornerstone of our strategy. And for example, we now see, in 2019, we were talking about hundreds of thousands of click-throughs via our mobile banking app from our messages, and now we're talking at tens of millions today, a lot of which is driven through this data-driven, customer-centric approach that we talk about. We also, through our customer-centric thinking, we really see the value of focusing on family networks to drive that high CLV. We see that parents who have youth accounts are both stickier and have higher lifetime value than those who do not have youth accounts. And that then got us thinking that really CLV can be used for beyond marketing and can really help us drive product creation, product strategy. And ultimately, that's what's led us to then acquire and then launch NatWest Rooster Money, as Zach mentioned earlier, in 2022. NatWest Rooster Money is an app for the youth and teen market that, through a set of parent-led tasks and chores, allows allows kids to be financially literate and improve their financial health and understanding, all delivered through our safe and secure personalized app. And since 2019, our share of the youth market has then increased from around 8% to over 20%. And it really validates the fact that we're trying to embed, deepen those relationships with family networks to overall improve the position of the organization and our customers. And with that, I'll hand over to Raad to finish off.
Thank you, Greg. So now that we've talked about the framework and how we use it, I'd like to shed some light on how we made it happen. So to start with, we really needed to understand our customers. We started with this management question of how do we understand our customers' financial journeys better to support them better. So to do so, we needed to understand how can we support our customers' financial journeys a bit better. And this really required us breaking down barriers across the organization. We had about 200 staff working in small interdisciplinary teams working cohesively together to make this all work. But to start with, we really needed executive support. Zach, who you've heard from today, was a major proponent of CLV to start with, which we were lucky to have, especially as he's seen the power of this as previous roles in Nissan and EA. But we really needed to convince our CEO that this is a good thing to do. So we worked with Zach quite closely to manage to convince her, especially as we were getting a lot of pushback from some of the other teams who were a bit skeptical about this program from the start. But once we managed to convince them, so we started with a small pilot that Greg talked about earlier. And once they've seen the results, we managed to start rolling out more widely across the different banks and franchises. And in doing so, one of the things that our CEO noted was the moment that some of the teams started coming back to her and presenting ideas about youth, primacy, and engagement as if they were their own ideas is the moment she knew that we succeeded. Now, to make it all work, we needed a strong program director. We also went through a lot of customer research and understanding our products and landscapes better. We also had a great delivery team leading the engagement and stakeholders in different work streams. And we had dozens of technical staff solving all these difficult challenges I discussed earlier. We worked closely with our independent model risk team to make sure that our model is independently verified and accurate and transparent. And once we had this all in production, we were able to start providing some of the marketing teams and customer frontline staff with the insights and training they needed to start to drive some of the strategy and marketing and make it better. And throughout this process, we really continued to engage with some of the product teams as well as our executives to see how we can really build better financial products for our customers and really target the right messages to them at the right time. So it's really been quite a transformation. With that, I'll hand over to David Lindberg, our CEO of Retail Banking, to say a few words.
Almost 20 million customers rely on NatWest, including 17 million retail customers. We have a responsibility to serve them well and to help them make the right financial decisions. Our customer lifetime value modeling proposition, developed with the leading academics, consultants, data scientists, and product teams, is helping us do just that. Together, we've developed a methodology that uses AI to give us a deep understanding of our customers' lives, needs, and goals. We're now able to target our communications, so we're able to talk to customers about the right things at the right time and in the right way. It's fair to say that this model has fueled a shift in the way we manage customer relationships. As a result, more and more customers are choosing to bank with us and deciding to stay with us. We've increased our main bank NPS from +4 in 2019 to +21 in 2024. We're better supporting customers and improving their financial health thanks to the insights we're gaining. Customer lifetime value modeling has been a key way we are embracing our responsibility of servicing our 17 million retail customers and supporting their success.
So I'll try to power through these next couple of slides. So as David said, this has really been a transformational piece of work for us as a bank. And we've even won an award for our initial retail CLV models, especially recognizing how we've managed to put this framework at the heart of what we do and our organization. And it's been quite transformative overall. And before I hand back over to Greg to wrap up, I'd just like to pause to highlight a quote from Pete Fader, who many of you may know. His work and Bruce Hardy's work has been really seminal work, has been really influential in our own decisions and how we built this. So getting this quote from Pete has been really something special. He's even gone so far as to call out the rigor of our work and even to say that it succeeded most of his own published work in the area. He's also talked about how we've overcome different organizational issues and even highlighted the ability for the potential for transportability to other sectors and industries. And with that, I'll hand back over to Greg to wrap up our presentation. Thank you.
Thanks, Raad. Yeah, so hopefully we've managed to show you that we have genuinely been on a journey as part of this group. We really wanted to set out a stall to understand how we can better anticipate customer needs and journeys. We've used data to understand that, to then use that to drive messaging, to acquire, engage, and deepen relationships, and then ultimately to evolve our product strategy. I think a key part of this is that as part of that organizational transformation, measurement and learning is a core component. And we now have this sort of virtuous flywheel where we feed that feedback back into the next iteration of the models of the data to improve things for the long term. We moved from a retail banking pilot into the full retail bank in 2021, then our private bank and our commercial business in 2023. And the next step for that is really to scale up how we apply customer lifetime value in our private banking and our commercial banking operations. And as Raad mentioned, I think we see scope for the same thing to happen across other industries. It really has been a large journey with a lot of people involved, but we are genuinely seeing that impact on the bottom line and the impact it's having on customer lives. So, thank you.
Just will ask some questions.
Here we go. Thank you. Fantastic presentation. Well done. So I'd love to just hear your point of view on what you think makes your CLV model different from other models.
I think for us it's the scale. I think it's the fact that we've taken that the best of what we can see in the literature, in the landscape, and converted that into something that has been applied to the whole organization, to those different banking units, and we are now targeting millions of messages every month to customers based upon that insight. We have a really rich view of our customer base from that data asset that Raad spoke about, and I think that is maybe unique from what we've seen in the literature. I don't think anyone else is doing things at quite the same level of detail and granularity to understand the behaviors of the customer and then using that to drive those insights and actions. So I would say that that's the unique thing that's different for us. I don't know if you can.
Yeah, I think the customer angle is quite interesting here. So we're really trying to understand customers' journeys to better target the right communications at the right time and drive different product strategies and that sort of thing, which I think is slightly different to some of the other work in the field, which is really focused on the firm's value that they receive from the customers. Yeah.
Thank you, guys. Love the rigor, and I obviously read your papers before the presentation, but I really love the rigor that you guys applied. My question, and it's actually two questions in one, but it's more on the link to how you applied it. Mm-hmm. I understand that you use your model to identify the most valuable, the customers with the highest value. I am less sure how you leverage that to actually action on it. So you compare with Fund My Business, for instance, and you said that you had like an incremental gain by applying the CLV model to one segment versus the other one. But what I noticed in your presentation is that Fund My Business didn't have exactly the same frequency, and I'm not sure about the creative. So did you bake this when you look into your analysis? Because obviously different creatives, different frequency will have also an impact on the results. So my first question is, did you bake that in your analysis? And the second one is, did you actually apply also this learning to adapt the creative and frequency, which seems to be the case? And then, if it is, would you not have had better results in the Find My Business campaign by applying a more personalized approach and a different frequency as well?
Yeah, so in terms of the frequency of those campaigns, it was the same frequency for the campaigns. The creatives were different, so that was not...
The emails I saw, one was bi-monthly and the other one was monthly, right?
Yeah.
Yeah. So you're right. So, and the creatives themselves were slightly different. I think that's something... I mean, I think it's part of it's one of the challenges that we have within the organization. I mentioned that there's a lot going on. There are many different teams all looking for their opportunity to sort of put something in front of customers. And that's one of I think in the commercial business, that's I think the next step we have to take is to make sure that the kind of customer centricity, the CLV approach is the way that we rank customers and use that to then target them in the same way. I think we haven't quite cracked that, not yet. That's the next stage that we're trying to go, so that just now there's a lot going on and everyone's vying for that attention, the eyeballs on on our mobile app. So that's still a place.
Yeah, there would be a lot of
development.
potential if you start to apply this findings into frequency, creative, personalization at scale.
Yeah, definitely. I think also that on the Fund My Business campaign, that one in no way used the same level of granularity or detail on the data that was used to understand the customers. It was very, just very basic information that they were using. Anything else you want to?
Just taking a step back to the start of the process where you said you had 400 billion, however million data points. Can you talk us through a little bit about the challenges and how you overcame them around user consent of aggregating that data, because you're working across multiple brands from what I could see. So NatWest versus Cushon, as an example, are very different customers and different entities.
Yep.
So user consent, I imagine, to, in terms of data provision, how did you manage to aggregate all of that across the different entities?
Yes, so within when a customer signs up for an account with the retail bank, for example, within the mobile app, they can then choose to opt out of marketing, contact and preferences, and opt out of their data being used for processing before it's then used for contact. So we respected that and removed those customers from the pipeline that feeds that 400 billion row of data asset. Those customers that do not want to be part of that, we respect those wishes and don't include them in that processing.
But that's across one brand. I guess my question is, how do you get consent to use that data in your CLV across the fact that you have multiple legal entities? Is that captured in?
Yeah. So I mean, so we respect the marketing preferences for each brand, and then when we do that aggregation, we take we only take the customers that would. If customers are set across multiple brands, we respect the corresponding preferences within each brand for that individual. Does that?
Yeah. So consent is allowed across brands. Yes. Is that
correct?
Yes.
Yeah. There's a question from the audience. I don't know if you.
Thank you. The scale and application is incredible, but I want to go back a little bit to the beginning of this project and what led to such a project, what was going on that led to the start and in a way embracing within the organization of such a project.
I think there were a few motivations. I think Zach coming in with his background from, he was previously at Nissan, at EA Games, video game producer. He had a radically different way of thinking about how we should be talking to customers and having them at the center. And he had previous experience of doing that in those other organizations. And he also had an excellent way of engaging at senior management, C-suite level across the bank to really get that buy-in. So that was a major driver for that change. As we, and I think we also then had to. That wasn't overnight. we got that initial buy-in, but we then had to do a lot of experimentation, showing proofs of concept, and over many months and years in some cases, we got that confidence across the businesses that this was the right thing to do, and they could see the results in black and white.
Thank you so much. And in the interest of time, let's just continue to the next presentation. But the author teams are here, and the audience can follow up with them during the coffee break. Thank you so much.
Thank you.
Thank you.